Okay. Hello, everyone. I am Lisa Twilley. I'm the director of the Women's Business Center here at Maryland Capital Enterprises. Thank you for joining us today. Um, just to give you a little bit of information about us, Maryland Capital is a nonprofit based here in Salisbury. We also have an office in Baltimore, and we assist entrepreneurs that are getting started in business or if they're already in business and trying to expand. We do business consulting, marketing consulting, training workshops, free training workshops such as this. We also do small business loans. So if we can help you in any way, we can help you with the business plan. We can help you with cash flow projections, as you're going to learn about. So we have Maria Randall here today with Lagnar Services, and she's going to tell you a little bit about herself and get started.
Hi, good afternoon, everyone. Thanks for joining. I'm going to go ahead and share my screen, and we are going to get right into this today. So I'm glad to see you all here. Let's see.
I'm so happy they got their faces, but usually everybody keeps their camera off, and it's like, this is awesome.
Right. All right, perfect. And then we'll go. Okay, so hopefully everyone can see this. Move that over. So it's kind of out of my way. All right, so we're going to talk about how to calculate your business cash flow today. Important topic for any business owner, or even prospective business owners, for sure. So before we dive in, let me tell you a little bit about my background. I'm Maria Randall, and I'm the CEO and founder of Ladner Services, LLC. I spent about 25 years as a small business lender prior to founding the company, and most of that time, the majority of that time, specializing in SBA loans. During that time, I've done loans to businesses in multiple industries, really, from government contracting firms here in our area to manufacturing firms, food service businesses, and done loans for a number of different purposes, whether it was business acquisition or startup, or if someone was looking to buy into a franchise. I got into the banking and financial services industry right out of college, and probably because my favorite courses had been in microeconomics and computers and corporate finance. I'm sorry. Actually, I did have a computer science component, but that wasn't my favorite part. But I always gravitated toward working with small businesses. So after a career as a lender, I formed Ladner Services to share what I've learned over the years and assist small businesses through the loan process, which can be pretty involved, pretty detailed at times. So certainly if you're a business owner who's considering applying for funding for your business, perhaps an SBA loan or some other type, or you just want a glimpse into what really goes on once you submit an application to a lender, then this presentation was prepared with you in mind. So cash flow is king. This is probably my most favorite slide of the presentation because it really says it all. This is one of my favorite quotes. Cash flow from operations is arguably the most important factor considered by a lender when
Maria,
evaluating a business loan request. Yes.
I'm sorry. Are you looking at a cash flow slide right now?
Yeah, cash flow is king. Yes.
Okay, because all I'm seeing is how to calculate it's the whole presentation. It has how to calculate your business cash flow. Is that
Hmm.
what you're looking at?
It's just that it's only that on the screen. It doesn't say cash flow is king.
No.
Hmm.
Well, over on the left-hand side is the whole presentation, but in the middle, it says how to calculate your business cash flow.
That's
If you,
interesting. Okay, let me stop sharing for a second and see what that view is showing. So I'll stop sharing for just a sec.
okay.
And
Did you have it in presentation mode?
mm-hmm.
Okay. it's like we were seeing your stuff on the side and then the one original, your first slide in the middle.
Odd. Let's escape. And let's open this bigger. Well, that's never happened before. Let's see. Put it back to that one.
Well, if not, you can just try to maybe click on the slide itself. Maybe it would pop
Yeah,
up.
let's see. Let's see if this. No. Okay, wait, let's see if this will work. I'll change it back to that. And then you can tell me.
Okay.
What about now?
Well, it was there and it just popped off again.
And now you see nothing?
Now I see your notes on the left and the one slide beside it. Click on presentation mode again. It's like when you clicked it, it showed up right and then it went off again. Like it's not staying in the presentation mode.
Yeah, that's weird. And what it's showing. Okay, here we go. Let's see if this will do it.
You guys are seeing the same thing, correct? Okay.
Sorry about that, folks. This hasn't
That's
happened
okay.
before. So let's see. Back, slideshow, center view.
If not, you might just have to click on that slide. Here we go.
Not now.
Now it's just like the computer. It's just like a big blue circle with
That
a
is
square in the middle.
crazy. Wow, what technical difficulties we're having. Literally have never seen this before. So, okay, let's see. One more time. Let's see if we get out of it and what happens if we start it again. We'll just go back to the drawing board.
It happens once in a while.
Yeah, that's interesting. Okay, so now it's always worked before. All right, so let's see. Okay, I think this should be it right.
Okay.
So let's see. Yes. Yes?
Yes.
Okay.
There you go.
I had to
Now,
close out of it to start again. That is
okay. So now if
great.
you want to advance to that screen you were talking about, then
I think, yeah, so I passed this one. This is cash flows. Okay, now do we see this? Cash flows?
now we can. Yes.
Yay.
Awesome.
Okay.
Woo!
All right. Good. Thank you, everyone, for your patience with that. And I guess what I was saying here is that cash flow is really the most important factor that as lenders we would consider when we're evaluating a business loan request. And just kind of to define it, literally, cash flow refers to the cash that flows into and out of your business in the course of day-to-day operations. Lenders mostly use the term cash flow, though, to refer to the net cash flow. So to the difference between what flows in and what flows out over a certain period of time, like cash flow in 2024 was so-and-so. It's referring to the net cash flow over that period of time. And it's really how much of cash inflow from sales and the things you do to create revenue is left over after cash flows out to pay expenses and, pay your employees or whomever. So if during the particular time period that is being reviewed, if more cash has come into the business than has flowed out of it, than has been spent to operate it, then there'll be positive cash flow. And so certainly the opposite is true as well. If more has flowed out than has come in during a given period, then cash flow would be negative. But cash flow is definitely king. Hopefully that slide advanced okay. So for SBA loans and other traditional lending programs, not hard money loans or some of those MCAs that I hate to even mention, having sufficient positive cash flow is a requirement for loan approval. So there could be great collateral, you could be pledging everything, there could be ample business liquidity, but if there is insufficient cash flow, then the loan cannot be approved. And sufficient or adequate in this case means really enough to cover the loan payments and still have a cushion, some kind of cushion left over. Now, how much of a cushion that needs to be is really going to be determined by the individual lender's credit policy. As to what size of cushion after you've covered these expenses your business still needs to have in terms of cash flow. So it's going to depend. So we know that cash flows into and out of a business in the course of its operations, and how important net cash flow is for a traditional loan approval process. So where do lenders really start when you've got a loan request on your desk and want to understand what the business's cash flow has been, where you're looking at their financials? Well, you're going to look to their business tax returns and or their income statement, also known as P&L statement or profit and loss statement, to find the information that's needed in order to calculate that cash flow. So it really is of critical importance that those documents are accurate. You don't want to just, print a profit and loss statement out of your QuickBooks system and hand it off to the lender without making sure that the figures that it reflects really are accurate, because that's what they're going to use to calculate the cash flow when deciding on whether or not they can approve your loan. And just to drive home the point, it is not bank statements or sales receipts or invoices that are used. It is your filed income tax returns, definitely for SBA loans, those filed tax returns. Or for some lenders, it is CPA prepared financial statements, which, as the slide says, they may be compiled, reviewed, or audited financial statements, which is the highest level of preparation that a CPA will do. But again, these are what are used to do the calculations for cash flow. It's not, looking at your bank statement and saying, well, oh, so you've had these deposits, so let me add that up. No, I'm going to go to the financial statements for sure. Usually when a lender is going to ask for copies of your bank statements for your business, and they will, it's usually to verify a particular transaction or verify how much, you've said you have available in the bank right now, but not for the purposes of understanding the business's cash flow. And so as the slide says, profit does not equal cash flow. Now, this is very important to note because the two are not the same. A lot of times you think, well, here's my revenue, here's my expenses, subtract that from that, and what's left over is my profit, right? But profit is not the same as cash flow. A business can actually show a profit, but yet have insufficient cash flow. And similarly, they could show a loss, but yet have positive cash flow. And we'll actually see an example of this a little bit later. So just want to keep in mind, just because you are showing a profit doesn't mean the cash flow is positive. Okay, so how is it calculated? Now, part of the advisory work that we do at Ladner Services includes helping business owners to understand their historical business cash flow and how to project future cash flow, and so that when they're applying for a business loan, they'll already have an idea of where they stand on this point. But as the slide says, lenders are going to first start with the net profit or loss reported by the business. Then add back the amounts of any non-cash expenses the business had. So such as depreciation expense or amortization or interest paid. And you'll see like these line items on your tax returns where that's captured. So those are non-cash expenses that get added back. And oftentimes there may be one-time expenses or expenses that are going to be non-recurring that may also be added back to the calculation. And many times if the business had one-time expenses, I'll say such as maybe new flooring installation after the basement flooded one year, right? And you had to get a new floor put in all over, and that's some huge expense. Or if you're a franchisee and every, let's say, 5 years or so, the franchisor requires a full remodel so that all of those locations, look the same. And those would be one-time expenses. Or if the business had, let's say, non-recurring expenses, like perhaps wages you paid or salary you paid to an employee who left the company and then you didn't end up filling their position. They weren't replaced. So there won't be that continuing salary expense. Or let's say you had a satellite office somewhere that you also operated out of, but you know what, when that lease was coming to an end, you decided, I don't need to renew that. We can do everything out of the main location. So that would be an expense, a rent expense that was showing on your on your tax return for last year, but it's non-recurring. You're not going to still be paying that rent expense going forward. So those are examples of expenses that could be added back into the cash flow calculation when a lender's trying to determine what the true cash flow from your operations is. Okay, so on this slide is the calculation, really in its simplest form. And I say simplest because depending on the particulars of the loan request, there may be other things that a lender may need to factor into the calculation of cash flow. That's certainly a possibility. But for the sake of simplicity, the calculation really is net income or net loss plus non-cash expenses plus non-recurring expenses, and we just had some examples, equals cash flow. Okay, so now let's kind of dive into a few examples so we can apply that calculation. And I know this print may be a little bit small, so I'll kind of try to narrate here. So here's a profit and loss statement for ABC Company. And they let's say they sell scented candles. So it's ABC Company doing business as soothing scent candles. I'm so into scented candles. I had to, have them be involved in that. And they did pretty well that year. They had $1 million in revenue for the year. After expenses, their net profit down here was 85,500. They had some depreciation expense, which is right here with the letter A next to it. They also had some interest expense, interest pay there with that letter B. You may be able to see this letter C over here, but we'll next to rent expenses, we'll come back to that in a later example. So in our calculation, 85,500 as their net profit, plus the depreciation expense, which we pointed out was a non-cash expense, plus interest expense of 27,300, gave them cash flow of $150,800. Now, right there, look at what the cash flow was compared to the profit. And remember, I said cash flow is not the same thing as profit. So you can see right there, big difference in those two numbers. Okay, so then here's an example of a different year for the same company, for my favorite scented candle business. They had revenue of $1 million again in this year, and you'll see some expenses, some numbers have changed, not much, but anyway, they ended up with a net loss, a small loss. They lost, 1,500 for that calendar year. So, having shown a loss at the end of the year, does the lender automatically, decline the loan and move on? Well, no, because profit is not cash flow, right? So just because they had that net loss doesn't mean that they didn't have cash flow. And you see the calculation here. So you take that negative $1,500, add the 38,000 in depreciation, add the 27,300 in interest paid, and look, they had positive cash flow of 63,800. So again, it is possible to show a loss on your profit and loss statement, but yet have positive cash flow. And I just wanted to kind of illustrate that example. Okay. So having positive cash flow is great, right? But now the lender's next question is going to be, okay, is it sufficient? Does the business generate enough cash flow from operations each year to repay the loan amount that they're requesting? So that's got to be, something that has to be determined early on. And in order to determine it, the lenders are going to calculate what's called the debt service coverage ratio, or DSCR. And this ratio, in a nutshell, it measures the business's ability to pay its debt obligations from the cash flow that's generated by its day-to-day operations. So what's the ability to pay the loans that you have outstanding or that you're requesting based on what kind of cash flow you generate from just doing, operating the business each day? And the debt service coverage ratio has to meet the lender's requirement in order for the loan request to be approved. So lenders will have their own credit guidelines, their own credit policy that lays out what's the minimum required DSCR for loan approval. And again, we are talking about traditional cash flow based loans here, not some of those alternative loans, that I mentioned earlier. So the calculation is here on the slide. Cash flow divided by total debt payments equals DSCR. And part of the advisory work that we do at Ladner Services includes digging into these very calculations. So when we're, let's say, looking to match a client with a lender, we know these numbers so we can quickly tell if, this particular borrower's loan request is going to meet a particular lender's DSCR requirement. Okay. So now that we understand the importance of the ratio and how it's determined, just before we kind of wrap up the presentation, I wanted to just take a look at a few loan request scenarios to just see the calculation in action. So on the top, you've got scenario A, where Soothing Scent Candles is looking for a $350,000 line of credit. Perhaps they need inventory in advance of Mother's Day, right? They need to ramp up their inventory and get some more candles on the shelves because, Maria has told everyone, hey, get me that, for Mother's Day. And typical repayment terms for a line of credit are interest-only payments with principal due annually or at maturity. So you see how that's noted up here. And this number, the 38,500, represents the total amount of interest payments for a loan of this amount, a line of credit of this amount for a full year. So you'll see that in the year that they had that $85,500 net profit, remember how we added the depreciation and the interest expense, and we got the $150,800 cash flow. So now we're going to drop it into the DSCR calculation, right, for debt service coverage. So it's the $150,800 divided by this number, the 38,500, which again, annual payments that will be due on the line of credit, and we get a DSCR of 3.92, right? So there we are with the cash flow divided by debt payments, and we get the DSCR. Now, if we come over here, this was the year that our favorite scented candle company took that loss, small loss. Same thing, adding back some depreciation interest expense got us to the 63,800. We dropped that down into our calculation, divided by annual payments, and the DSCR for this year was 1.66. Okay. Now, scenario B, we've got down here, this business is this time around applying for a commercial mortgage of $950,000. This is an SBA loan, so it's got a 25-year term, and with SBA loan payments, principal plus interest are going to be due on a monthly basis, right? And so when we look at, and we plugged in a 10% interest rate here, but 950,000 at 10% over a 25-year term, we get monthly payments that multiplied by 12 come out to 103,592. So this is what their payments will total for a full year. I'll say, if you'll see this extra line C, right, for rent for premises. So remember on the earlier P&L statement we looked at, and I told you we'd come back to that letter C. Well, in this case, they're going to have we're going to be able to add this back, this particular expense of 74,300 back into the calculation because they're buying the building. They're not going to have this rent expense anymore. So that rent that they've been paying all these years is now a non-recurring expense because they're going to own the property. So in this case, for the first year we looked at, having that additional add back, that brought our cash flow to 225,100. So again, we drop that down into our debt service coverage ratio calculation and divide the 225, 100 by the 103, 592, which again, total of principal and interest payments for a full year, right? And we get a debt service coverage ratio of 2.17. And then, again, we can look at the calculation for the year that they had the loss, where we're adding these same things in, adding our rent expense in, excuse me, our cash flow for this year, 138, 100, which we bring down into our calculation. Now, these numbers are getting a little close, right? But we still came out with 1.33 as the debt service coverage ratio based on that year. So now the question is going to be, well, whether or not this debt service coverage ratio is sufficient. And remember, it depends on whatever the minimum that is required for approval by the particular lender, the particular bank that you're applying to. If the bank is using the SBA loan program, and we talked about this being an SBA loan here, one thing to know about the program, you may already know this, is with an SBA loan, it is actually the bank who's making a loan, loaning their own funds, just like they would with any kind of traditional loan. But if they follow certain guidelines specified in the SBA's particular loan program, as long as they do that, the SBA will provide the bank with a guarantee of a certain percentage of the loan amount in the event of default. So it's a great incentive for a bank because, let's say the guarantee is 75% of the loan amount, right? If they make a loan to a business of $1 million and, worst case scenario, the business goes out of business, there's a default. Instead of the bank taking a loss of a full $1 million, they tap into the SBA guarantee. The SBA gives them 750,000, 75% of that, and their loss is less. Their loss is only 250,000. So just to give you a bit about how the program works, because it is still the bank making the loan and getting this guarantee, the bank, excuse me, still gets to apply its other kind of lending criteria. And so I say all this to say the SBA's minimum debt service coverage ratio is 1.15. That's what it needs to be as far as the SBA is concerned. But the bank can have a higher one. So if the bank's is, it could also be 1.15, it could be 1.25. If the bank's minimum was 1.5, 1.50 that they need to see, then in this year, where we had 1.33, that might be an issue for the bar. Well, it would be an issue because they would not have the minimum needed for loan approval. And really, what would they do in this case? It's not likely that the seller is going to lower the purchase price for the building, right? That would be nice if we just say, oh, I can't quite get this. Can you just lower the amount a little bit? What would usually happen then is the borrower would probably have to put in more of their own funds in order to bring the loan amount down low enough so that the annual principal and interest payments on that loan would be smaller, and in our calculation bring it down below this 103,592, so that when we're dividing here we hopefully get to a high enough debt service coverage ratio. So that's kind of how it works and what would be going on behind the scenes. If oftentimes if a lender may say, oh, well, we don't quite qualify for that amount, typically it will be because of a debt service coverage ratio issue. So I just wanted to give that example. And just to recap, for, as we've said, for SBA loans and others, adequate cash flow from business operations is required for approval. Lenders are going to use data from your tax returns and financial statements to calculate cash flow, not from the bank statements. We already know business profit is not the same as business cash flow. And the amount of cash flow that's generated from business operations really will help determine what loan amount the business can afford to repay, and basically what loan amount the business can be approved for. So, you know, as we said, there are ways to address the loan amount in certain circumstances, right? If it's the mortgage example that we gave, then an option could be to lower the mortgage, the loan amount by putting in more funds. But there may be, you know, some types of loan requests, depending on how the loan proceeds are going to be used, where maybe that's not an option, right? Or maybe there aren't additional funds to put in toward toward the project. So it's always going to be dependent upon what the particular lender's requirement is, and how you get there, and having an understanding of how you get there, you know, is something hopefully that can be beneficial. So at least, you know, you're all on the same page when they're talking about these things, and evaluating a request that that you may submit. So I welcome any questions. Before that, let me thank you for your attention today. I hope you got something out of this session that is helpful to you. And certainly if any of you are considering applying for a small business loan and may want some assistance, or rather putting or finding a appropriate set of assumptions to go with your projections, not finding, putting that together. Those are all kinds of things that we assist with as well. And my contact information is here on the screen. So we've got a lot of time left in this session, and I am happy to answer questions.
Any questions, anyone? You can just unmute yourself and ask. Casey saying, thank you for this information. What do you recommend for startups looking for microloans when there is no cash flow?
So that is a great question. So for startup businesses, you are not going to have anything historical. So it's about cash flow projections. A lender is going to want to know what you project the cash flow of the business to be, and not by you sort of doing the calculation per se, but by you projecting what your profit and loss statement will look like at the end of the first year, end of the second year, and typically end of the third year. In many cases for startups, looking for projections for the first 2 to 3 years of operations is the norm. Be aware, though, that year one is typically preferred to be by month. So month 1, month 2, month 3 through 12, projecting what will your revenue be, what will your expenses be, that you know in these individual months. And then from that, the lender would calculate your projected cash flow for that period. So it does come down to, you know, really thinking that through, like depending on your type of business. If you are, you know, you're going to start a smoothie shop. How many smoothies do you expect to sell in your first month of operations. How much is a smoothie? Is it $7 or $9? I've seen smoothies $12. You know, what's going to be the average ticket price multiplied by the number of smoothies you plan to sell? You kind of get into that in projecting what your revenue is going to be. And then what are your expenses going to be? Or the employees that you're going to pay salary to, your rent, your things like that. So if you're doing that on a monthly basis for month 1 through month 12 to get to a full year, a lender's going to want to see that. And then also, well, what do you expect year 2 to look like? Should revenue be a little bit higher? But it would be your projected cash flow that they'd be calculating, since a startup business wouldn't have any historical information to go on.
Okay. Did you have any questions about that? The cash flow projections? And Portia, yes, we're going to send the slides out. Okay. Anybody else have any other questions? So, Maria, so what are some of the banks, like when you're talking about, do you know any of the banks' different scores, like that you have to have for the DS?
For the DSCR, a lot are around 1.25. I know sometimes that, let's say it might be 1.25 for a mortgage or a term loan. It might be 1.50 for a line of credit, because it's open-ended and maybe perceived to be a little bit riskier. So I couldn't name to you off the top of my head, you know, specific banks and what their
Right.
ratios are, but typically in that range. If the bank is less conservative, you know, you can expect to see higher ones. There are a good number of non-bank lenders who, let's say, who do SBA loans, who will go with the SBA minimum, and they're perfectly fine with 1.15. They don't have a different policy. So it just depends.
Okay. I was just wondering.
Yeah.
Okay. All right, you're getting some comments here. This is very informative. Thank you very much.
Sure.
I'm reading your chat here. I put my information in the chat, so if anybody has any questions or think that we at Maryland Capital Enterprises or the Women's Business Center can help you, please let us know. I don't know if I mentioned this in the beginning, but we do cover all the Eastern Shore of Maryland, Baltimore City, Baltimore County, and Anne Arundel County. So if you fall in one of those counties, then we can help you, like I said, with business consulting, marketing consulting, cash flows. Maria can help you with getting ready for a loan, the whole process. So please reach out to us. That's what we're here for. And we do have other workshops coming up. So right on our website under marylandcapital.org, you can register there. If you'd like to be added to our newsletter list, please email me and I'd be glad to add you to that, because that's when you find out more about the classes and different events that we have coming up. Thank you so much, Maria. We appreciate your time. It was very informative. I loved it.
Absolutely. Thanks for the opportunity to share. And hopefully, you know, you may not need this information now. Maybe you need it later, but you know, knowledge is power. So thanks for the opportunity to share that.
Thank you. All right, guys. Well, thank you for joining us, and let us know if you need anything. Have a good day.
Bye.